Okay, so let me ask you this. What do you look for in a stock? Is it low valuation or strong fundamentals, future potential? Baidu checks all of those boxes, at least on paper, but it's not everything it seems to be. And that's exactly what makes this stock so fascinating. One day, Baidu's up on economic stimulus news, and the next is giving a value trap vibes. Let's start with Baidu's recent share performance. Back in September 2024, Baidu shares saw a nice surge fueled by Beijing's 1.4 trillion economic stimulus package. Big news, right? But here's the thing, the excitement fizzled out and Baidu's shares are now back to where they were pre-stimulus. Classic case of buy the rumor, sell the news, right? In fact, Baidu's valuation looks downright attractive, is trading at just 7.5x forward earnings for 2026 with an earnings yield of 13%. That's way cheaper than peers like Alibaba. Even after revising the fair value estimate from $166 to $150 per share due to macroeconomic challenges, there's still significant upside potential here. For context, analysts estimate like an 80% upside from current levels. That's not too bad, right? And then there's Baidu's stock buyback program. This company's been buying. They've repurchased 1.4 billion worth of shares since 2023. They even announced a $5 billion buyback program earlier last year. With a free cash flow margin of 8% in Q3 2024, Baidu has plenty of room to keep rewarding shareholders. Now, let's just zoom out and look at the bigger picture right now. China's economy hasn't had the best few years. Weak consumer spending, a real estate sector drowning in debt, and a slow recovery from COVID-19 have all weighed heavily. But Beijing's massive stimulus packages aimed at turning those things around. The eased lending restrictions, lower mortgage rates, and increased spending on infrastructure could benefit major players like Baidu in the financial, real estate, and tech sectors. Here's why that matters for Baidu. The Chinese economy is projected to grow by 5% in 2025. That's a solid growth and could be the catalyst Baidu needs to boost its core business, especially online advertising. Speaking of core business, Baidu's bread and butter is its search engine, right? With a 45% market share in China, it's the clear leader in search, driving consistent traffic and profitability. In Q3 2024, Baidu's operating income growth actually outperformed big names like Alibaba and Tencent. That's despite the fact that revenue growth was flat. Now let's talk about the margins, right? So Baidu's reported an EBITDA margin of 31% in Q3, down slightly from 32% last year. It's still impressive, but it shows that Baidu isn't immune to macroeconomic pressures. And while revenue growth slowed to 0% last quarter, it's worth noting that this was largely due to external challenges, not internal failures, right? So here's where things really get interesting though. Baidu's trailing price to sales ratio is just 1.5 and its forward PE sits at 8. For comparison, the S&P 500 average PE is around 30. So yeah, Baidu is trading at a fire sale price right now. On top of that, the company has 8 billion in net cash with 19 billion in cash and equivalents and 11 billion in debt. Financially, Baidu is as solid as it gets, but the market doesn't seem to care. Baidu's stock trades at just 25% of its 2021 peak. Now, of course, there are risks and challenges. No investment is without the risk. With Baidu, there's a plenty to consider, right? So first, there's the government influence. The Chinese government's lack of transparency and control over tech companies has scared off many of us investors, especially ones in the US. The regulatory crackdowns of 2020 are still fresh in everyone's mind. Now, second, the online advertising market isn't exactly booming right now. Revenue from online market dropped 6% year over year in Q3, and management isn't expecting a big turnaround in Q4. With advertising making up more than 70% of Baidu's revenue, this is a big concern. And let's not forget geopolitical risks. Tensions between the US and China could escalate, potentially leading to more restrictions on Chinese companies, which is always a factor. But then you look at it on the flip side, Baidu has some exciting growth drivers, right? Especially in AI. If the Apollo Robotaxi program has completed like 8 million rides to date, with nearly 1 million rides in Q3 alone, that's up 20% year over year. And Baidu's AI cloud business is growing as well with an 11% year over year increase in revenue last quarter. These advancements might not move the needle immediately, but they're laying the groundwork for long-term growth. But here's the thing, AI monetization is still in its early stages, right? While Baidu is integrating AI into its search engine and app, it's unclear how soon these efforts will translate into significant revenue. So now, where does this leave us? Baidu is a stock that's undervalued, fundamentally strong, and positioned for recovery as China's economy stabilizes. The risks are real: government control, geopolitical tensions, and a slowing advertising market. But if you're a contrarian investor who can stomach some uncertainty, Baidu offers a lot of upside potential. And I mean a lot. Here's the bottom line: Baidu isn't a slam dunk, but is far from a dud. It's a company with strong financials, exciting AI initiatives, and the ability to reward shareholders. Is Baidu worth the gamble, or are the risks just too high for you? Let me know in the comments below. And don't forget to like, subscribe, and hit that notification bell so you don't miss future updates. Thanks for watching, and I'll see you next time, guys.